Hello, my name is Hugh Keefe, and today I will be talking about Denbury resources. This report was put together by a group of MBA students at Tulane University. The information in this report is as of March 23, 2011. Denbury is an independent oil and gas company based in Plano, Texas. The company engages in the acquisition and exploration of oil and natural gas properties in the United States. Denbury's core competency is CO2 enhanced oil recovery from mature oil fields. The company is the domestic leader in CO2 oil extraction, historically relying on its unique ability to leverage its own source of natural CO2. Denbury has grown substantially in the last decade to become a mid-cap company with a market cap of $9.6 billion. Here's Denbury's one-year price chart. As you can see, Denbury's stock has risen along with oil's recent price appreciation. Before moving on, it may be beneficial to provide a background on CO2 enhanced oil recovery. There are several different ways to extract oil from the ground. Primary recovery uses the oil reservoir's own pressure to bring oil to the surface. Think of this as the Beverly Hillbillies type oil. While enhanced oil recovery involves pumping external elements, such as water or CO2, into the well. Denbury pumps CO2 in mature wells, causing the oil to swell, which allows the oil to be collected through a production well. This process yields an additional 15 to 20% of a well's oil. As oil prices trend higher, more of these projects will make economic sense. We believe EOR projects will continue in popularity as technology improves and oil prices remain relatively high. In 2009 and 2010, Denbury completed and integrated approximately $4.6 billion in acquisitions, doubling the company's oil reserves. The largest acquisition, Encore, expanded the company's operations outside the Gulf to include the Rocky Mountains and the Bakkens in North Dakota. This expansion includes oil recovery potential through fracking in the Bakkens and CO2 enhanced oil recovery in the Rockies. The two Texas fields also present CO2 enhanced oil recovery opportunities. This slide is a geographical representation of Denbury's current operations. Denbury has experienced significant growth in its tertiary oil operations. Currently, Denbury has identified 9 phases of oil production growth. Gulf Coast tertiary activity began in 1999 and now includes the first 5 phases, which only contain fields in Mississippi and Louisiana. These initial phases have exhibited a 33% compounded annual growth rate since inception. Subsequent phases will expand into new areas like Alabama, Southwest Texas, and the Rocky Mountain region. Given the company's position in the enhanced oil recovery market and its ability to acquire mature oil fields at reasonable costs, we expect Denbury to continue its strong growth into the future. Denbury relies on its ownership of natural CO2 resources at Jackson Dome in Mississippi. The company is currently drilling additional wells and is seeking contracts for natural CO2 in the Rockies. In the future, we expect the company to be able to recycle approximately 50% of the CO2 used in tertiary activities, as well as contract with power plants to attain their captured CO2. This slide shows estimated CO2 reserves at Jackson Dome. This figure may be bolstered through the drilling of new wells and the ability to recycle previously used CO2. Denbury does not have a pure competitor in the CO2 enhanced oil recovery space. However, the company has many independent competitors in the oil and gas exploration and production industry. We selected a peer group based on revenue, market cap, and operating region. Relative to its peers, Denbury does not represent much of a value play. However, we believe the company will find success as more fields are converted to tertiary production. We should also note here that Denbury has significant capital expenditures due to high upfront costs relating to the CO2 pipelines associated with enhanced oil recovery. This slide breaks down Denbury's operational, regulatory, and financial risks. One major operational risk is Denbury's business model requires sufficient CO2 supply. A regulatory risk is that Congress may add hydraulic fracturing to the Safe Drinking Water Act regulations, and this will have additional costs for operations. A financial risk is creating the necessary liquidity to satisfy their debt agreements. We use the combination of DCF analysis and relative valuations of price to earnings, price to cash flow, and enterprise value to EBITDA to arrive at a 12-month target price of $24.26. At today's price of $23.91, we believe the company is fairly valued. Given the volatility of the price of oil, Denbury stock could become much more attractive on a pullback in the price of oil. As of March 23, 2011, Denbury was trading at $23.91, representing only a 1.4% discount to our target price of $24.26. As such, DNR has earned a Birken Road rating of Market Perform. Thank you for listening. A copy of this research report and all other research reports are available at www.birkenroad.org.